is really cool to see that there are a lot of people in here that are looking to improve on trading. I think a lot of people get into it with the false reality that they're immediately going to jump in, especially when they have that big beginner's type of luck and, they score big early and then, it's kind of a marathon and that luck might wear out. But I will be here to tell you that this is very possible to do this at and be very effective in doing it. But without, here's the cliche, the corny BS that you see on Twitter all the time. It does come to a point where the level of screen time that is necessary to get to that point of success is definitely not, an overnight type of situation. So realistically, my goal for tonight, and, if anybody's in here and they got the mic on, just if you would mute that, that would be great. But the ultimate goal for tonight is to essentially, prove to you all that every single move that occurs on this chart can be justified now, and that they are completely not random. Okay. And I think by the end of what I'm about to show you guys, you will all ultimately agree with me in one way or the other. Now, here's the one thing. We could have all the, I don't even know what the proper term would be here to use, but we can have all of the perfect ideas and you name it, and we could see it clearly and we can justify both sides of the trade, but that does not necessarily mean that we are always going to be 100% right. So hold on, let me just mute some. I might have to just server mute. Yeah, so anyways, but even if we see a situation where we can justify a long or we can justify a short, what do we do in that case? Right? Maybe we sit on our hands. Maybe that's the best option in that specific scenario, right? And oftentimes, I've been through this as well, all throughout learning and growing as a trader myself, that oftentimes when I have that conflicting idea, and in the past when I'd say, oh, you know what, it might be a long here, I'm going to take it, oftentimes it didn't work out for me, right? It just seems like it always goes against you in that way. So one thing that I've improved on drastically over the last 3-4 years is in situations where I can justify a long and I can also see the short side to the trade and almost a clear light in both directions, that's probably the best time for me not to do anything, right? So again, just to go back to this, the key concept that I'm going to be going over tonight is the term imbalance. Okay, there's two types of imbalances. And both of them can go in either direction, whether it's a bullish or a bearish imbalance. So I'm going to show you, how to find them because, without being able to identify them, they're pretty useless, right? What they are, I'll give you like that textbook definition. I know some people like to learn that way. And, if we have time towards the end of this, how you can use this to essentially map your trade prior to even entering into the trade. So even if, you are on the wrong side of things, you will be able to use that information to, where's your entry? Where's your stop loss? Where could you be looking to potentially take profits, right? All of that should be predetermined, pre-planned before you even enter the trade. And that's why I don't, I've come to terms with the fact that I am not going to be 100% perfect in this game. To me, I really don't even believe it's a possibility. You are going to lose, but how you lose is what separates good traders from great traders. If you do not know how or can't justify where that trade might go wrong for you, that typically leads to you getting caught in what I would call quicksand. And what I mean by that is, how many times have you looked at a chart and you taken a trade off of a specific level and said, okay, if it drops below here, I'm getting out of the trade, right? But then it gets to that point, and maybe it happens really fast, and you start to say to yourself, oh, well, I do have another level like right below it. I might just wait for that one, and then we'll see from there, right? And then it gets to that level, and you continuously get dragged under, not only by price moving in the inverse direction to where you want it to go, but also you're dealing with theta, especially because I'm sure within this group right now, there are probably a lot of options traders, right? I trade options still, but predominantly at this point in time, I am trading futures. And, just to keep it brief, with futures, can the risk be a little bit more than what a smaller or cheaper type options contract could cost? Absolutely. The reason why I like to trade futures really is you're not dealing with theta, so there's no time decay on your trade, which I like it a lot. And also I like being able to place my entry, exit, stop loss, you name it, all on the screen for me. That way I know exactly how much money at all times I'm going to potentially win, potentially lose. And when you're dealing with options, it's not so cut and dry, right? That would be a great invention if somebody could come up with that, where you place your stop loss in terms of whatever the options premium would be. But, obviously, anybody who's running the market probably wouldn't want that because they love taking our money. So anyways, um, also, just an extension of what else I want to show you here is just how, you might see a lot of really beautiful and well put together charts on Twitter from a multitude of different people. But oftentimes there's a lot of substance that is lacked. And what I mean by that is there's really no explanation that you can give based on using these specific indicators, right? Oh, well, it lost this MA, right? Oh well, it failed. It made a fake breakout. You're meaning to tell me that you feel comfortable placing money into a quote unquote potential fake breakout? That sounds like the craziest thing I've ever heard in my life, right? And I used to do it all the time, and it was so dumb, and there was no justification to it, and that's why I needed more. I needed to understand why price would have done that fake breakout, right? I needed to understand, oh, you know what, it went down, $1, and it's still hanging on to my MA, so obviously I'm going to cut my trade because I don't want to get run over. And then 2 seconds later it runs up, and I would have killed it, right? I needed an explanation as to why that happened. And to me, the ability to read price really does paint a crystal clear picture. And something that I say to this group, pretty much every day, every time we go on a live, is once you see it, you can't unsee it. And I hope by the end of tonight, some of you are going to say, whoa, this is crazy, right? And it's not something that's all that complex, right? You'll look over here. I have 2 indicators on the chart right now, and neither of them have anything to do with me essentially making any sort of decision off of. This one right here, this is just times. So if we were to go onto my smaller time frame here and pop it over, where is it? It's not even on here. Okay, yeah, I don't even have it on this one. But it will label specific times throughout the day, because time is a major component to reading price action that not many people are aware of. And I might save that for another time, a different seminar potentially. But time is incredible. It really does kind of paint even more of a clear picture, right? You might see some sort of setup, but if your time doesn't line up, you're going into a lunch hour potentially, or you have no economic data on that day. It might get choppy, right? And you could foreshadow or see into the future that, okay, typically when we don't have news data, or typically at 11:30, we typically don't get moved. We get consolidation or choppy price action. Is that a trade that you want to be in? Especially if you're trading options, probably not, right? It's just going to fry your theta. And let's see, I got another thing here too. Oh, also, most importantly, for anybody who's watching right here, I might speak strongly about other techniques and other strategies and stuff like that. And really, the reason for that is because while I use them, I was just never consistent enough for me to actually make money doing it, using the moving averages, using the options flow, this, that. To me, it just wasn't for me. So if I'm saying, I don't mean to at anybody or anything like that. I don't mean it in a negative light. It's just, it really didn't work for me. And until I found this, I didn't feel like I could really justify anything that really happened on the chart. It was more of like I'm just winging it type of situation, right? But ultimately, I'm not telling you that you should change your entire methodology, right? If you've had some success and maybe you have one missing piece, and maybe one thing that I show you guys tonight is like the aha moment. Oh my gosh, now this makes a lot more sense. If you can incorporate one thing from anything that I say here tonight, that's a win, right? That's the way I look at it. And then, oh, okay. And lastly, obviously, we'll get into it, but this is important to note, at least, that at first I want you all to at least think in your head and maybe drop it in the sidebar, just a chart. I'm only going to do a couple of them. It'll be more towards the end, but whatever chart you're thinking, whatever time frame it is, doesn't matter. I just want to show you guys that these concepts, it doesn't matter what time frame you're looking at. It doesn't matter whether it's a futures ticker, whether it's a option ticker, stock ticker to play options off of. It doesn't matter if it's crypto. It all plays the same. And again, that's something that I aim to prove to everyone here, that you'll see that and you will hopefully be able to learn something from it and maybe even incorporate something new by doing all of that. So with all of that being said, let me, because my mouse just died. Where's my other mouse? Okay, so the first chart, of course, that I'm going to start on is just NASDAQ, and we'll go through and we will justify every move. The reason why I asked you guys to think of just a chart is just because I don't want you to think that this is cherry picked. Oh, I picked a couple charts here that I show you guys and how it works all perfectly. You can, any chart, I don't care. We'll go through it. Actually, I do have one caveat to it. Please don't make it a penny stock. That's all. That's the only thing that I ask you not to, not to send in. And I can explain the reason why I wouldn't want any sort of penny stock to be added in. But all right, so let me just pull up on this sidebar here just to see if you guys have typed anything into the side. Hold on. Okay, let me come over to the chat. Okay, cool. Okay, cool. Yeah, so if we have time at the end, of course, but I want to be able to show you guys that, again, nothing here is cherry picked. Okay, so with all of that being said, what is an imbalance? Okay, so what an imbalance in price is a specific region or area on your chart in which it's lopsided, right? So the example that I use to kind of explain, why would something be lopsided, or how would price react to something being lopsided? And what I mean by lopsided is that there is either a sell side inefficiency or a buy side inefficiency. And if that's the case, you're going to have some sort of imbalance. Now, here's the way I kind of, have shown people in the past, or have kind of used like an example as a way to explain my point here. But think about it this way. If you're sitting on a seesaw or teeter-totter, whatever, at the park, and you're on one side of it and nobody's on the other, naturally, you're going straight to the ground and the other side's going to be up in the air, right? Now, that's exactly what I want you to view this specific region, and we'll use this one because obviously price did retrace back into it. But in this candle here, inside this specific region, where again, I'm going to show you, there is an imbalance in price. And imbalance to what side, right? Well, if the price is moving higher and you see that on either side of the candle there's no wick, okay? So you'll notice here, you'll notice on this candle as well, you'll notice on that candle as well, even on this candle right here, right? Look how perfect. There is an imbalance in price. And in this situation, you have a buy side imbalance and an inefficiency to the sell side. So what that inefficiency is the other side of this, seesaw teeter-totter that's up in the air, right? So in order for that seesaw to come back into balance, you're going to need to throw, like, let's just say, a sandbag on the other side, right? So, your first attempt at putting a sandbag, it still might, not be balanced, right? So that would be a situation where price reaches into set imbalance and it takes off, right? Could it come back later? Absolutely. Price in this range is still not balanced, okay? But how do we use this as a way to, help us, make decisions in terms of how we're going to trade off of it, right? Ultimately, with that being said, as price gets into the imbalance, right, a specific region within here are going to, or a specific region of this area in terms of from this wick to that wick, entirety, a complete imbalance within these two candles. That might be balanced, but ultimately, as price gets in, we would expect for price to kind of get up and go, right? Some view it as resistance or support, I should say. Me personally, I would prefer to view it as a launch pad or a bounce, right? And as you can see by what we're seeing right here, here's your retracement into the imbalance, there's your takeoff. Here's another imbalance, here's your retracement into it, and you take off. And this goes on for as long as possible. Now, earlier I said that we had multiple forms of imbalances, right? We have the fair value gap, and we also have a volume imbalance. And I think everybody in this group is probably pretty familiar with the volume imbalance, whether you believe it or not. So that's why I go with this one first, because it really doesn't take all that much time to kind of explain. But if you're to look here and you see how we have that gap higher, right? Anytime we get a gap up, what that's telling me is that there is urgency for price to move higher. Okay, so we can use that gap as a level of support, right? Now here's something that's interesting, and I'm you might have heard it all over Twitter, whatever, it is what it is. But if you notice, when price gets back into these imbalances, everybody always wants to say, oh, there's going to be a gap fill. There has to be a gap fill. No, there doesn't. Go on any chart, look back in time, look back in history. There are millions of charts in which there is a gap that had occurred, and there is a gap that was not completely filled, right? So I think that is a huge misconception, right? Price gets into that volume imbalance or gap, and immediately everybody says, oh, that gap needs to fill. No, it doesn't. Literally go back on any chart and back test it for yourself. You'll see almost immediately that that is not the case. Okay. Sean, I saw your message. I said 8:30 sharp, and I said 8:30 sharp because I wanted to get into it. I don't want to waste anybody's time who actually came on time. So but a volume imbalance. So a gap higher is showing you urgency higher. Look what happened when price got into it today. Took off. Okay. I'll show you an example of what a bearish volume imbalance would be. Okay. And then ultimately we will get into the volume imbalance, because again, that is a I'm sorry, the fair value gap, because that is the one you're probably going to see more often intraday trading, right? So ready, here's just an example of a bearish volume imbalance or a gap down. Whoops, here it is. There's your gap lower, okay? Showing you urgency to move lower. Price retraces up into that volume imbalance and meltdown, okay? So that's just a way you can use it, okay? So ultimately, that's the volume imbalance. Gaps higher show you urgency to move higher. Gaps lower show you urgency to move lower. How is that actionable? Well, essentially, if you just wait for price to retrace back into it and not try and jump into it once you see it kind of take off and leave, that's something that I think a lot of people want to do as well. To me, especially using the concept of an imbalance, I prefer buying my longs off of red candles into my bullish imbalances, and I like to take shorts off green candles into my red or bearish imbalances. Okay, to me, that's the most bang for your buck. You're limiting what your potential risk reward would be. You're maximizing what your risk reward would be in that situation. Ultimately, if you're buying something on a red candle with a specific stop loss, by doing so, you're trimming what you could potentially lose by buying on the candle that is actually going in the different direction than you, right? It's something that's hard at first because you don't want to do it. You almost want that extra little bit of confirmation to tell you that you're going to be right, and that's why people jump in, and oftentimes it'll be a big wick back, and then people start to panic, and oftentimes people panic sell as a result of that. But I think that also kind of comes from maybe lack of experience, or really just not having an idea of listen, at the end of the day, I joined Twitter in 2020. People literally used to have in their bios that they were breakout traders, right? You don't see that much anymore. There's not many left. And listen, in 2020, when the overall consensus was up, right after that COVID low, everything just went absolutely berserk with the inflow of money, yada yada yada. Now, those breakout traders probably did great during that time, but now understanding the concept of liquidity, which is a seminar for a different time, it's a little bit longer than what just an imbalance really is. But that concept of liquidity, once knowing that kind of frees you from the idea of the breakout type trade, right? So that would just be kind of how I map out in terms of, okay, for example, you have an imbalance like this. In this situation, obviously I'm looking at a NASDAQ weekly chart, but you can kind of frame your bias using this, right? You have a bullish imbalance here, and again, I will show you the fair value gap in just a second, but I just want to show you again, how does this make sense, right? So again, there's an imbalance in price within this specific price range. Okay, this is something that we can backtest, and we're going to on any chart, and we'll be able to walk through every single move that happens on every chart, because every move is justified, right? If we can kind of see that on either side of that trade it gets a little fuzzy and you can kind of see it both ways, maybe that's just not the best time to take the trade, right? So hold on one sec, sorry. So taking a look, and I just want you guys to look at these candles right here on this entire run up, right? And again, when we go through your chart, we will go and get them done. So ready? There is your right there, right? Let me just delete it so you guys can see it more clearly. Okay, so if you're looking at this candle right here, you're going to notice that on our left from this candle's high, there is no wick or price is not being contested within this entire region. Okay, so that would be our first little dot. Okay, now if we're to look over to our other side of the candle, you're also going to notice the wick stops right here, right? So on either side of this candle in this specific range, price is uncontested or imbalanced. And ultimately, what direction is that imbalance moving in? Well, this candle's going up, right? So, you know, with hindsight, of course, right? Think about it. If this candle had no wick at all, you'd be coming down all the way to here, right? Because price within that range is uncontested. But price was contested on this whole wick, okay? Up until this point, you'll notice we stop dead in our tracks. We make that imbalance up and through, and we have no, you know, sell side or sellers present within this specific range of the chart. So how do we view that from that point? Okay, well, if there's an imbalance in price, or price is not contested within this range, by using, of course, back testing and our ability to, you know, practice, we're going to notice that oftentimes when price retraces back into these imbalances, especially on that first attempt, we're going to get that wick in and bounce from that level, right? And so on. Similar situation right here where you have your, here's your low wick, there's your high wick. So again, we'll draw it out again, but you'll notice, right? Once you see it, you can't unsee it, right? You never ever would have expected anything like this to play any sort of role, okay? So there's your wick, body, wick within this specific range right here. You'll notice there is no wick to either side, therefore price is uncontested in this specific range of your chart. So if price is to retrace into this range of our chart, we would be under the understanding that price will likely get into it and get out of it, right? So that's a kind of way that you can set your entire bias. And again, we're looking at the weekly. So, you know, if you're to go back on Twitter and kind of look back and, you know, go back to October, you go at MANDOTRADING, and then I like this low a lot. And it was literally on this day. Sean, I know you're in here. Sean also took the trade with me here. And we literally nailed the bottom of this entire move, right? And there was complete substance behind everything that we had envisioned in this situation, right? So, you know, ultimately, price getting into our imbalance, we had a good idea of we were currently in discount of that imbalance, and that's something, again, for another time, probably a little later within this little voice call. Yeah, we still got time, good. But when price got into our discount imbalance, we took off. We felt real good about it, and you know, ultimately the rest is history. That was about 3,400 points ago, right? So by using the weekly to kind of dictate or formulate our bias, that had allowed us to, you know, be on the right side of the trade more often than not, knowing that our draw on liquidity is higher. Okay. But again, just two examples, and then I'm going to show you. I'll go into any chart that you guys want, and we'll kind of run through these. But if we're to take a look right here, here's our imbalance. Again, wick, body, wick. Look on either side of these candles. So it's a 3-candle kind of situation here, right? Without this candle right here, right, you still don't have an imbalance, right? You might think one could form, but you actually want to let it form, okay? You don't want to jump the gun and, you know, say off the open here, buy it, and then potentially see some drawdown, even not create the imbalance, and that can get a little dangerous. And I'll show you an example of that in a second. But obviously this weekly candle sets itself, you create the imbalance like that, okay? Either side of the candle, right? No wicks within this specific range, so that when price gets back down into this imbalance, we take off, okay? Here's another situation, okay? Here is your wick, body, wick. That would be your imbalance. Price retraces, and this is the first week of January. Remember, everybody thought the world was ending? Crazy, right? And if you go back this week, whatever it was, so 8, 9, 10, so January 11th, if you do at MandoTrading and January 11th, you'll see very important for bulls to get a wick back to this candle's low. Why? Because if an imbalance formed, to me, that's no good for the bulls, right? Price retrace back into there, forget about it, right? To me, that would be the range setter, and we would be looking for lower prices at that point. But the fact that the bulls came back up here and closed in what would have been an imbalance, right? Anybody who tried to front run this death candle, right? Because remember, the world was ending, right? They got smoked literally almost immediately, right? Not even 5 days later, we were back up into this range. So that's why, I like to let them form, and that way, if I let them form, and if it takes off without me, so be it. For example, if we got this move here, we got this down move, and the next candle was just an absolute melter, I missed the trade. So be it. I want to have some concrete, fabric to my trade thesis, and that way I can kind of base my decisions moving forward off of what I'm seeing currently, right? You'll even notice if you watch the live session from yesterday, my first thing for today was I need to see what happens when price gets into here. Go back. It's on YouTube, right? And the reason I said that was because we do have a bullish imbalance right here, right? But another seminar for a different time, but this is previous buy side liquidity right there. We swept that last week, and look at our reaction to that. We came right back down, okay? So after taking liquidity, this is just in short, I'm not going to give the whole in-depth analysis on that, but after taking out higher time frame liquidity, right, you want to wait for a reaction. Do you create an imbalance to the upside? So if you are to create an imbalance to the upside, that would give you that little layer of confirmation that we are actually going to break out or have some sort of continuation move. If we sweep the high and we pull back like we did and form some sort of imbalance to the downside on that next candle, which is still possible here. I know it's crazy day today and everything looks bullish. I'm not discounting that whatsoever. But if this candle were to close down and create some sort of imbalance to the downside, then that would to me be a liquidity sweep, and from that point I would start to be looking for lower prices in discount of the range. That's just the bottom line. But again, I wanted to do this, and this is going to be something that's relatively quick, but this way, by me showing this, I can show you that technically you have 4 types of imbalances. You have your bullish fair value gap, which I showed you, which is wick, body, wick. Bullish volume imbalance, which is a gap higher, right? We have our bearish fair value gap, which is the same thing, wick, body, wick, just to the downside, right? And we also have our bearish volume imbalance, which is a gap down. That's it. So in reality 2, but obviously 2 sides to the trade, so you have 4, okay? But let's walk through the entirety of what we've seen on NASDAQ for really years now, right? So if we're to take a look here, we'll notice that, okay, we obviously had a massive run up throughout COVID, got up to this high in November. Even from this point right here, right? I'm not so sold that we are going to completely melt down just yet. Why? There was no imbalance formed, right? The imbalance is almost the market tipping its hand to me and telling me, okay, look, price is going to start to retrace from this point into discount of our range, okay? So if we're to take a look at that and look at it from this perspective, where did the first imbalance occur? Ready? Here it is. Wick, body, wick, and since it's to the downside, this is a bearish fair value gap, okay? So that's letting us know price is going to start moving down without us, okay? Now, continue on. We swept this low here, beautiful, but check this here. Here's another bearish imbalance. Look what happens when price gets into that imbalance. Reject and puke, right? One more time. Reject and puke, okay? And so on and so forth. Here's another. Ready? New imbalance formed right here. Ready? Wick, body, wick. Okay? From here, ready? Another one right here. Wick, body, wick. Look what happened when price got into it. Bloop. Every move is justified. Why would we bounce here? That is the concept of liquidity. Took out our swing low. Here's a bullish order block. So again, every move can be justified, and that's kind of why I want to show you guys ultimately that every one of these pops, every one of these rejections, they're all coming from something. It's not just random BS, right? And to me, I think that can be very enlightening for people. So again, first attempt up into this imbalance, right? Rejection, dump, okay? So from that point, I'm good here, okay? On the flip side of that, you have your first imbalance to the upside. So again, just like we said with the downside trade, right? When you have the imbalance to the upside, that's kind of telling you, that's the market hinting at itself that we're going to continue moving higher here, okay? So we do move higher, shift market structure by taking out this high. Here's your retracement, and there it is, bullish imbalance, right? You guys all see it, and I'll remove it just so, and I'll replot them so you guys can see it. But do you see how there's a wick, body, wick? Beautiful. That would be green because it is an up close candle. Price gets down into our imbalance, and what do? Take off, okay? And we continue higher. Here's another situation where you have a gap higher, bullish volume imbalance, okay? Price wicks down into our bullish volume imbalance. Here's another one just for show. And again, we take off one more time. Whoops, I gotta do that again. Here you go. Okay, price continues on higher. Okay, now where do we run into here that price rejects? Okay, here's our imbalance. For another time, but here is buy side liquidity. Whoops, right here. Swept the high. One of two things are going to happen. Obviously, you're either going to get that imbalance candle higher. That's going to offer you or show you that price is looking to continue or make that breakout move, or you are going to get some sort of downside imbalance after sweeping liquidity, which we got here. Price comes down to here, right? Why would we bounce here? What's the explanation for it? So not only do you have, that bullish volume imbalance, I know I'm kind of cheating here, but we also had a daily imbalance on that price point here, but there it is. Every move is justified. Look what happened. That's a bullish volume imbalance or gap up, right? Does this gap fill immediately before running almost 1,000 points? Nope. There it is. Wicks right into it, takes off, okay? Why would price reject here? Again, for another call, this is right here would be a bearish order block. Just another concept that you can use, but the bearish order block would be an up close candle followed by a down close candle that closes below this candle's open. Okay, so if you've ever heard of somebody say a dark pool print or something like that, typically that dark pool print is going to paint something like this. Okay, and what that means is, you might see, oh, a dark pool print, I wonder what direction it is. Look how the candle paints. If you get this type of paint, you know that dark pool print for $4 billion on SPY was likely to be a sell. If you see it from the flip side and you see, oh, $4 billion, and you get a down close candle followed by an up close candle that closes above the open of the previous, there you have a bullish order block. All right. So as we continue on, again, just to be clear that every move on here can be justified, we reject our order block, retrace lower. Okay. Second attempt into this imbalance. Look what happens. Oh, we lose this after the second attempt. Okay. Why does price bounce here? Wick, body, wick, bullish imbalance. There she blows. Price gets into it and bounces. Okay. Why would price reject here? What? That doesn't make any sense. Ready? To the flip side. Wick, body, wick, bearish imbalance, bearish fair value gap here. Price gets up into it, rejects lower. Okay. Now, here's where the fun starts. Price gets into this bullish imbalance here. Again, another concept for another time, but this is a bullish breaker, and in short, it is a setup that looks like this: low, high, lower low, and a break of that high. We would anticipate this high candle acting as support, in which it does as well with that bullish imbalance. And the rest is history. All these imbalances to the upside. We have one here that got retested and took off, and another one retested and took off. So that's where we are currently on NASDAQ, of course. But again, I just wanted to show that every single one of these moves can be justified. Here's the tricky part. Now that we're at our all-time highs, where do we go from here? What's next, right? And without having information to my left, it is a little bit difficult for me to identify what our potential draw on liquidity is, right? Because we use pools of liquidity as a way for us to kind of direct where's our target going to be. Okay, so if we're to look at it weekly, obviously we're at this point only about 84 points off our all-time high at this point, right? So it is difficult to try and pinpoint what exactly our drawn liquidity is in this current situation. But so yeah, that's just the nuts and bolts of it. If anybody has any questions, feel free to drop them in here, and I can go through it as I show you on whatever chart you guys ended up picking in here. So Melsky wants to look at ES. Yeah, ES is going to be very, very similar in that. Okay, so for example, here's your bearish fair value gap here. I haven't charted this in a long time. Retracement up into it, rejection. Retracement up into it, rejection. Melting down, lower prices. Okay, why would price reject right here, Mando? Bearish imbalance. There it is, rejecting. Okay, where else? If we're to zoom out and go over there, why did price bounce right there? Bingo, ready? You have a bullish fair value gap right there. Okay, do you see that? Beautifully done, right? Every single, somebody's trading futures out here right now. I heard that, water filled. Okay, so ready? We continue on. I mean, literally every single one of these moves, again, should be able to be justified. So not only do you have this bearish volume imbalance right there, which we'll get to later, you also have a bearish fair value gap. Okay, right there. Price gets up into it, rejects. Price gets up into it, rejects. Price gets up into it, rejects. Beautifully done. And we continue on, obviously. We end up making our move higher. Why are we bouncing here? Well, you have bullish volume imbalance right there. Let me just zoom in and show the precision of this. Okay, there she blows. There she blows. Also, you have a bullish order block, down close candle, followed by an up close candle that takes out the open of the previous. Again, a concept for another time, another call. You also have this bullish volume imbalance here. Price retraces back into it, takes off again. Here's a bullish fair value gap right here. Wick, body, wick. There it is. Price retraces down into it, takes off. And one more time later on for good measure, you'll notice that, yeah, we swept these lows, but no candle ever disconnect from our level here, right? And if that's the case, then there's no reason for us to take it off the chart at that point, right? After about 7 tests into this specific imbalance here, we finally get up and through. Similar situation here. Price gets up into it, rejects on our first attempt, but our drawn liquidity at this point is higher, and we continue to move on higher. Price gets up back into this bearish imbalance, and we reject. Why would we reject here, Mando? Okay, bearish fair value gap right there. Price wicks in, rejects, moves lower. Okay, why would price reject here on these high wicks? Bearish fair value gap, wick, body, wick. Price gets up into it and rejects lower. We take higher time frame liquidity, another concept for another time. Sweep lows, take off. Okay, also held on to that bullish fair value gap right there. Let's see, did we get any attempts at retracement here on SPY at all? I don't believe so. Let's see. Ready? Let's zoom on up. Okay. Hold the phone here. Yep. Okay. So obviously this is our rejector here. Even on this candle, look where price closed or rejected from on this first or second attempt. I'm sorry. Price got all the way to the top before pulling back, ultimately getting up and going. But just like NASDAQ, here's your retracement. So an imbalance up through buy side liquidity. Here's your retracement down into a bullish fair value gap, and that's where we currently sit. So that's ES. Again, every move is, it can be justified. And I'll go through some more charts here too. CGC, great question. Do you use this strategy on intraday timeframes as well? Yeah, this is one component of it, right? So if you were to go on YouTube and look up my trading model, you're going to notice, and I do a more brief explanation of these imbalances, but the three concepts that are kind of put together to form my trading model are my imbalances, so bullish, bearish, volume imbalance, or fair value gap. That's it. So imbalances as a whole. Also liquidity. So again, for another time, but liquidity is essentially your swing highs and lows. And just to be as brief as possible, what I mean by that is what had to have happened at this exact candle right here. This weekly, so this week, July 24th, Monday, what had to have happened here? People had to be selling, right? So if people, and by people, I don't mean you and I mean people who actually have money enough to move a market, right? Hedge funds, institutions, maybe even big money traders, they're going short here. And the odds are those traders are probably not going into that trade without any sort of, protection or, a way for them to not get absolutely smoked if they're to be wrong in a current situation, right? Maybe one hedge fund's on one side of the trade and the other's on the other. They got to protect themselves in that case so that they don't get absolutely destroyed. But those swing highs and lows, we know that there are stops that are there, aka money, right? Aka liquidity. And we know that the market needs liquidity in order for price to move. If there's no liquidity, aka penny stocks, right? That liquidity is going to be needed to come from outside of what we currently have on this chart, right? You never hear anybody get arrested for pumping and dumping Tesla. Why? Because the liquidity that's necessary for price to move is already on the chart. And that's why I think volume is a trash indicator. I think it's so lagging. Every time you see a big volume bar come up, I bet you we took out a higher time frame swing high or low. Don't take my word for it. Go ahead and back test it. It happens every single time. But ultimately, the market is targeting these pools of liquidity. Look, bingo, right? So that's really where I'm using for my, take profit. And on the flip side of that, that's where I'm using my stop loss on the same, flip of the coin there, because I know that if price goes below it a certain point, aka where does market structure shift, right? And that's the third component to my model. If price were to shift market structure, while we could still get some sort of bounce, I don't believe that bounce is going to be anything more than just a discount retracement into some sort of imbalance for me to look to trade that short to the downside, right? So it all kind of formulates and comes together when you have a better understanding of not only the imbalances but also liquidity and market structure. I think, really, I think my model is very simple, and it's something that there's a bunch of people in here who are using it now. It's funny when they post, oh look, it's Mando model setting up, and it I'm not even in the trade. It's hard to keep an eye on a million different names. So it's just interesting to see like them trading it and using it, and it's not even something that I was looking at. But what else? Let's see. Oh, how do you anticipate a bounce from imbalance versus inverse fair value gap? Yeah. So essentially, that comes from being able to identify what is your market structure. Okay. So again, something that I've taught in the group obviously for a while, but where are we more likely, or where do we get the most bang for our buck, right? We're thinking of this as retail-minded people, but or retail-minded traders, I should say. But if you go to the grocery store and eggs are typically $5 and they're having a sale on them, you're probably more inclined to buy something on a sale than you would if they say, oh, we're raising the prices to $7 now, right? That would be you essentially overpaying or buying in premium, right? Overpaying for your long. And the reason for that is if 50% is equilibrium or fair price in a specific range, below that 50% is technically a discount. And that's why I look for discount imbalances, because I know that when price wants to retrace back down into those, not only is my risk reward great, but the ability to go back in time and back test and prove that it works, you know, and it happens over and over again. You know, in the group, if you guys are all in here now, go check out that Mando model tab in the Discord. There's a million, and that's only, you know, probably like a fifth of all of them that occur since I started that group. So, but let's see. Yeah, Phils, I'm if we have time towards the end, I got 10 minutes left here, and I want to just go through some more of these charts just to, again, you know, back my claim that every price can be, or every move can be justified on here. So, let's see. Did anybody else post any other ticker names? Yeah, okay, good. Disney, beautiful. Oh, man, I wish I still had the tweet from it. If you're curious, go on Twitter, go at MandoTrading, $Disney. They don't allow you to pin your tweets on here anymore, but you'll see what I said on October 2nd about Disney. But yeah, so Disney, look, just in short, every single one of these. Ready? Why did price reject here, Mando? Bearish fair value gap. Okay. Why did price reject here, Mando? Bearish volume imbalance or gap down, aka showing you urgency to move lower, right? Why did price reject here, Mando? Bearish fair value gap. Okay. We want to see these bounces. We're going to go back a while, but we'll find them. Okay. What is this right here? I know I showed you briefly, but bullish order block. Down close candle followed by an up close candle that closes above the open of the previous. So your order block in this situation would look like that. There she is. 1, 2, 3. All of these little bounces that had occurred were out of that bullish order block. And so on. Why did we reject here, Mando? Bearish volume imbalance. See it? Price gets into it. Dump. Okay. What about here? Okay. Why did we reject here? Sloppy PA, but still plays. No close above it. No separation from it. Whoops. Bearish volume imbalance. Price gets up into it. Rejects. What else? Down here. Why would we reject after this candle? Make another new low, Mando. There she blows. Retracement up into a bearish fair value gap. Down she goes. Down she goes one more time. Okay. I mean, what else? Okay. This bounce right here. Why did we stop dead in our tracks right here? Bearish fair value gap right here. See it? Every single one of these moves can be justified. Okay. Now here's the thing with Disney, and this is what kind of ticked me off. I'd posted this one a while ago, but not only did we take out the higher time frame liquidity, we also got into this bearish imbalance. I really wanted an opportunity at Disney to catch it in discount of this range, right? And if you look at our retracement here, held on for dear life, but bullish fair value gap. See how it never separates from that level? Ugly and annoying that I didn't get this discount retracement. So price moves higher, I miss out on an opportunity. It is what it is. It sinks, but to me, if I have to be more robotic and pinpoint with my entry and not, oh, you know what, it didn't get down there, but I'm going to take the trade anyways. That to me, just you're going to end up losing more than you're going to win at that point, because you're not following any sort of specific game plan to get to a specific point in terms of here's my entry. If I don't get it, I miss it. Oh well, guess what? There's a list of 500 other stocks here that I can trade that maybe one of them meets my criteria. And if it meets my criteria, great. I like my odds there, right? Let's go again. PayPal. Where's PayPal? Oops. Every single one of these. Ready? Whoops. There's not many green candles here, not many retracements, so you know it's still going to play, obviously. But if you're to look here, you're going to notice, okay, what was the start of this downside move? It was, whoops, here. There's a discount retracement, beautiful, and flip. Was it flips? Fills. Yeah, fills. So ready? Here, you're about to see my model in action. Ready? Full speed. Okay. Higher time frame liquidity swept. Bearish imbalance to the downside. Okay. Range is set with that 50% retracement. Bearish imbalance. In discount above that 50% in a bearish range would be your discount. Here's a bearish order block just on top. and there's your rejection. Once we sweep that low at 266, Mando model complete. On to the next. How do I map my next range? Okay, well, we go from the high that took out that low here, which was here. And if you notice, you can go to every single one of these green candles. Not once did we retrace to 50%. And if we do not retrace to 50%, this is all stuff I'll go over on another time too, by the way. But if there's no bounce to 50%, the range isn't set, right? So that's what they say. Remember, they say don't catch falling knives. That's exactly what they mean by that, right? No one could, people who say that probably couldn't even explain it, but that's exactly what they're saying. If there's no range set, why are you jumping into the trade? There's no reason for you to jump into the trade, right? And just here, just overall continuation. Look how massive this range on PayPal is. It's just absolutely disgusting. But again, like literally every single one of these moves, like completely justifiable. Where do we get any little bounce? Okay, right here. Why do we bounce and reject here, Mando? Okay, ready? Bearish fair value gap multiple times. Dump. Why do we reject here? Bearish fair value gap. Dump. Why do we reject here? Bearish fair value gap. Why do we reject here? This one's a little sloppier, but still gonna play. Ready? Whoops. Bearish fair value gap. Okay. The reason why I say this one's a little bit more sloppy is just because if we zoom in just a little bit, you'll notice you get the wicks above, and look, that's, you know, this kind of goes to, you know, how I actually trade using this stuff. But in short, when I'm playing off these imbalances, I don't necessarily have my stop loss placed at the high of these. I use the candle that created the imbalance. So while it might enhance what my potential loss could be, to me, just again from back testing, from learning from the person who I learned all this stuff from, that's their methodology, and it's something that, again, go back and back test it. It plays very well. But again, you know, just onto our continuation here. Oh, why did price reject here? Bearish fair value gap. Why did this candle wick and reject? Bearish fair value gap. Check. What else? Literally any of them. Here, why did price reject here? Well, you also have this. Again, really sloppy and gross, but there she blows. To the downside, price gets here. Oh, why did we reject? Not only do we have a bearish order block, there's a bearish volume imbalance. Price gets up into it, never disconnects to the upside, and you get the dump. Why did we reject here? Bearish fair value gap. There she goes, another leg down. And here's where, you know, I almost said to myself, wow, PayPal might not be a bad idea, right? Because if you look at this, right, if you look, we'll go all the way over. But, okay, why do we bounce here? Bullish fair value gap right there. And we swept higher time frame liquidity. So with that, it's like, oh, maybe we will get that reversal, right? That's a possibility. Taking higher time frame liquidity typically would, you know, offer that type of potential in that situation. So when I saw this, because look, you're going to notice, oh, wow, we did disconnect from that level. That's great, right? Awesome. But with hindsight, of course, here's your bearish fair value gap that we got back into, and here's a bearish order block. Price gets up into it and melts down, dumps, sweeps another low. Price gets up into here, rejects this candle here. Shouldn't have that black on just yet. Okay, price gets up into here. Here's your bearish fair value gap, rejection, melter, and that's where we are currently on PayPal. So one thing of note: low, high, lower low, swept higher time frame liquidity, and got into a bullish fair value gap. Potential for a bullish breaker here on PayPal, believe it or not. And to me, if we can escape this breaker here, then I believe 76 is in the card. That would be our draw on liquidity, right? Swing high. That's where I think price is going to go. That's where, you know, we need money in order for this to move. It's got to send price in the direction where we're going to be able to get some money. So, okay, that's PayPal. Again, I just want to go through every, you know, let's just do two more because I know it's almost an hour here. But, okay, bearish imbalance to the downside. Okay, bearish imbalance here. Price gets up into it, rejects lower. Here's your gap down or bearish volume imbalance. Price wicks up into it, dumps. Also, all of these wicks here. Why? Wick, body, wick. Rejection lower. Why do we bounce here? Bullish. Okay, so here's, you might see this on my chart, and I just want to clear this up. So in this situation here, you have a bullish volume imbalance or a gap higher, but also take a look, and you don't see this on futures. You only see this if you're doing individual tickers. A lot more gappy than you'd get on futures. Futures trades 23 hours a day, 5 days a week. A lot more information available there than, opening at 4 a.m. and closing at 8. Okay, and we know how much stocks gap up, especially nowadays. A lot of the moves taking place, while everybody's sleeping. But here's your bullish gap higher, bullish volume imbalance. Okay, but also notice on either side of that candle, right? No wicks, right? We can use that to our advantage, right? No wicks on either side. We know that price range is imbalanced. Same situation up here. Look, no wicks on either side of that candle. We know price range is imbalanced. Okay. So that's just a little bit of an extension. And if you see like a weird, like, oh, I wonder what that is that he has charted right now, you know, that's what it is essentially. But let's see what else. Swept liquidity here, bounce in our bullish imbalance again. Multiple attempts right here. Why? Bullish volume imbalance right here. Bing, 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 bing. Okay. What else? Rejection here. Bearish volume imbalance right there. Price gets up into it, rejects. Lower we go. Okay. Same situation here. Same imbalance. This time we didn't take buy side liquidity, but bearish order block here as well. Bearish order block here as well. So you're working with two bearish order blocks at the same, time essentially. And obviously we know that by look how much of a consolidation we got on IWM for so damn long. I do think this is the year it gets going, but sheesh, this is like almost 2 years of consolidation. Wide range, but consolidation nonetheless. Finally after sweeping one more low, enough to get us going, price takes off. Okay, where does price bounce from? Bullish imbalance, check. Also a bullish breaker again for another time. Price gets into it, and so far so good. So that would be IWM. But I hope you get it kinda now. Goonie, on smaller time frames to reset fibs after breaking previous high, is there a range for sideways price action that you disregard when picking the high of the current range run up? Okay, so what I think you're saying, I could be wrong, and if I'm wrong, please correct me. But what you're saying is when you use the higher time frames, if price stalls out, to me that doesn't matter. This is the way I look at it. Unfortunately, today's not a great example of it because once we took off, we were a goner. But check it. Ready? So like you might say, okay, how do I know what current structure we're in? And when I say structure, aka trend, right? But it's giving me like an actual explanation on what a trend really is, right? People say, oh, there, it's a bullish trend, but is it? Have you identified that? How are you identifying that? Because sometimes you can get upward price action and actually not be in a bullish trend, right? I know it sounds crazy, but it's just the truth. But anyways, on this run up, right, I look to my left and say, okay, this high was taken out with what price run? From this low to this high, okay? And you're going to notice, you're going to say, oh, well, your fib's not there. And I do not trade using Fibonacci. I just use it to measure a range, okay? It's very important. If there's no imbalance down here, which we didn't have, there would be no chance of me taking a long in that situation, right? So we have a bullish market structure, okay? Now I wait, discount retracement. No discount retracement. It's gone, right? And as I continue on, for every one of these little rejections, is there a discount retracement? Nope, 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 nope. So we have a massive range currently, right? Because throughout this entirety, right, there was no discount retracement. Like we just missed it here, but we did not quite get to that 50% mark. And if we don't get to that 50% mark, to me, the range just isn't set yet. And if the range isn't set yet, then there's going to be that continuation move in which we continue higher. But look how interesting this is, okay? Think about any one of these imbalances. And today I opened up this entire call by saying no high impact data today. I didn't even look at futures, right? I was kind of just camped out in my Tesla and I was watching that. But I typically tend not to trade on those days where there's no high impact data, and I don't try and front run data. That's gambling. I don't do that. I wait for after 8:30 news, whatever it is, and I'll look to trade following that. But that's like a little influx in volatility, which makes trading a lot more fun. But you're also going to notice, look at this entire move. There's no imbalance formed, right? Like we'll zoom in and just confirm, but ready? Wick, wick, no imbalance. Wick, nope, no imbalance. Wick, wick, wick. Oh, okay, we do get a little one right here. Ready? Very small, microscopic. We actually didn't even get a retracement into it, but there it is. Okay, we continue higher. No, 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 no. And this is I think what you were referring.